We had a bounce in the stock market today with the S&P 500 up about 0.5%, largely due to one stock, Nvidia, which has a sizable market cap of $500 billion these days and was up 14% today. So that sent the technology sector soaring higher than the other sectors today. And of course, technology is the most important sector in the S&P 500. So we did have about 62% of stocks in total higher on the day. And we also saw that there was a little bit of slippage there in the interest rate environment, which caused a little bit of a bounce in the bond market as well. So we'll talk about all of that, see what it means for our posture. We'll have some additional analysis with our 12 grids. We'll take a look at the factor selector. Then we'll get into our trade application example, where I wanted to focus on a different semiconductor company that's also setting up as a bounce candidate up and off of its rising 30-day moving average. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 23rd, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Remember, at the bottom of those emails, you'll also find which stocks are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and I really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. And for the most part, it was a pretty promising day. S&P 500 was up about 0.5% today, so not the most rip-roaring rally we've ever seen. Nonetheless, it does seem like there was some pretty decent breadth associated with today's move. The one that probably stands out the most to you is Nvidia. That was the best performing stock in the entire S&P 500 today. It was up 14%, so a pretty solid day for that company. I was mentioning in my question and answer session earlier today that my top-down trend trading class that we have here for premium members actually has 2 out of today's 3 best performing stocks in the S&P 500, where Nvidia was a recent addition to our portfolio here, as is Quanta Services, PWR, which is not a stock that gets talked about a lot. Kind of helps utilities build out their infrastructure and different things like that. But anyway, that stock was up about 7.5% today. That was the 3rd best performer in the market. And then there was a technology company, ANSS, that was the 2nd best performer in the S&P 500, up about 10% today. So, some nice movers to the upside, but of those 3, there's no question that it is Nvidia that is the eye popper, because as you can see, its market cap is over $500 billion these days. So it is one of the most important stocks in the entire market. And to have a stock of that caliber up 14% in a single day, that can offset a lot of weakness elsewhere, right? It completely offset the weakness you might have seen in Alphabet as an example, where it was down today. Netflix also had a little bit of a challenging day. I understand that they are changing some of their pricing practices in other parts of the world. I think here in the United States, things will stay as is, but they're reducing their prices in some of the other parts of the world. And so investors didn't seem to take too kindly to that idea, as perhaps they are assuming that it means lower profitability moving forward. Other big movers, let's see who this one was. This is Moderna. Tough day for, of course, that company that has become quite popular here in over the last, let's call it 2 or 3 years, as a result of their involvement in the COVID crisis and them being one of the bigger players with the vaccine issue alongside of Pfizer, of course. So they struggled today, down about 6.7%. Let's see what else is out there. How about this one? Here's a bright green one, and that is Dish Network, and that stock was up about 5% here today. We saw that Bath and Body Works was up about 4% here today. We saw that Coterra Energy was up about 6% today. I would probably throw AMD into the conversation. It was up 4% today. So all in all, some pretty solid movers there. And really where we had a bit more of the red were in areas that really are not kind of the supposed risk-on segments. So for instance, what catches my eye from that perspective is we had a lot of utilities that were down today. Looks like there were most of the utilities in the red today, which is different from most of these other sectors. You can also see that there was a healthy portion of consumer staples that were down today, with Walmart and Costco, Procter & Gamble, Colgate, Kimberly-Clark all in the red, but you had an equally offsetting amount of green ones as well, with Coca-Cola and Pepsi and Philip Morris and Altria, etc. So a little bit offsetting there within consumer staples, whereas within utilities it did seem like it was a little bit more consistently bearish there. I would also say that you probably have a little bit more bearishness within consumer discretionary here today, but fortunately the three big and most important ones of Tesla, Amazon, and Home Depot, they were all up today. And so it was kind of some of the smaller players. It's hard to say that Starbucks is a smaller player, but compared to Tesla, it is. And so you did have some of the next level lower players closing in the red there. You also saw some of the telecom players in the red. And similar to the utilities, I tend to think of Verizon, AT&T, T-Mobile is kind of similar to a utility mindset, where those are more often than not kind of risk-off types of sectors that are out there. We did have a number of dividend announcements today, so for those of you that have been following my Twitter feed, you've probably been seeing a lot more of those announcements coming out, in addition to our massive snowstorm that we had here in Utah yesterday. I'm sure many of you in the Midwest and out east are probably getting that now, but holy mackerel. I posted a photo of my neighbor's car, and the only thing I could see of my neighbor's car was the side mirror. The rest of it was completely engulfed in snow, so it was a doozy, one of the biggest snows that we've ever had here. So I hope all of you are getting through that okay. Not a fun experience if you get trapped out in that, so be careful out there. But anyway, otherwise my Twitter feed tends to be focused on kind of dividend announcements and things like that. Of course, yesterday I had a lot of commentary around Intel, and that followed through here today in my teachings at Market Scholars as well. For those of you that were not in my question and answer session earlier today, be aware that I taught the longest class I have ever taught in my career. And remember, I've been doing this for a long time at this point, but today's class was 4 hours and 40 minutes, where I just sat there and answered questions without getting up. And so normally I have to shut her down at 3.5 hours, but David had to reschedule his class, so it allowed me to go a little bit longer than normal today. And out of that 4 hours and 40 minutes, a full 2 hours of that time period was dedicated to my thoughts on the Intel dividend cut announcement. So if you are a premium member and you're interested in hearing my thoughts and commentary around that, feel free to check that out. It is posted to our website right now. Anyway, as we take a look here at the rest of some of these, one of them that caught my eye, and that's why I kind of started that conversation, was Chubb. Chubb was down today, but they did announce a dividend increase here earlier today. Of course, they are a dividend aristocrat with more than 25 years in a row of increases. Another one that announced its dividend increase today out of the aristocrat space was ESS. I'm not sure if I see it over here. I'm sure if I look close enough within the real estate area, it'll pop up. Where is ESS? I am overlooking it apparently. No, there it is. Okay, so there's ESS. It was up a little bit today in the normal session. And then here after the bell tonight, we just heard from Albemarle as well, and that is a dividend aristocrat in the materials space. And as I mentioned on Twitter, it has handsomely rewarded shareholders over the years. In fact, when we bought it in my dividend growth investing class, we're already up quadruple on that. And it's only been a few years since we've been in it. That's not normal for us. Usually dividend stocks are slow-moving companies, but Albemarle has been a true grand slam for us. It was up 3% in the normal session today, but when they announced their dividend increase after the bell, it was a bit of a disappointment. They only raised it by about 1.2%. So most of their cash flows and earnings are probably going back into building out their lithium mining opportunities, getting ready for what is likely to be a lot of EV batteries and electric vehicles on the road here in the future. So always fun to see some of those dividend increase announcements as well. It's an easy way for you to get paid more money for doing absolutely nothing other than being a shareholder of some of these companies that are generous with their dividend policies. All right, let's go ahead and pop on over here now to our main part of our platform and get a better sense of our breadth numbers. And as you can see, I got the S&P 500 pulled up in our watch list area under the Visualize Market Watch tab, and 309 stocks out of the 500 in the S&P 500 closed in the green here today. So that was good for about a 62% hit rate. So, quite a bit more stocks in the green than in the red today. Popping on over here now to our charts, let's have a lay of the land with our 4-grid. And as you can see, I've got chart 4B pulled up here in front of us in case you wanted to follow along with the presentation here. Remember, one of the key benefits that our premium market scholars have is they get access to all 50 plus of the customized ThinkScript charts that David and I use during our classes and presentations. So on this particular 4-grid, it allows me to see the 4 major U.S. equity indices and quickly get a sense as to whether their intermediate posture on the market forecast technical indicator is either bullish or bearish. Remember, the background colors will tell us that information over the current candle. And so for 3 out of these 4 charts, which are the S&P 500, the NASDAQ Composite, and the Russell 2000, we have a light pink background color. That's kind of that concept that I had mentioned to you guys last week of the idea that there are storm clouds out there. We just don't know if the storm clouds are going to lead to anything yet. It's basically giving us a heads up that there's been a little bit more wear and tear on price action here recently. So we stand with a weekly bearish posture on those 3 indices. But notice up above on the Dow Jones Industrial Average, that is that darker shade of pink behind today's candle. And that means that that is a strongly bearish posture. So that's a legitimate storm that's already taking place. It's no longer the clouds. This is a storm that's getting a little bit more aggressive. It doesn't mean that it can't correct itself and the bulls can't step in and try to save the day. It just means that the selling has been a bit more aggressive in the Dow is one way for us to determine that the Dow is this market's current laggard. And that is nothing that is new to those of you that have been watching this presentation, because I've been saying that for the last month or so. But what is interesting about it is late last year, the Dow was actually the leader. And so it's kind of been interesting to watch the Dow pass the baton to some of these other indices as we started 2023 and kind of take its spot in the backseat as opposed to kind of driving the market. So right now it seems like it's the big blue chip companies that are a bit more out of favor, and it's kind of some of the more up and coming growth oriented areas that are a bit more in favor at this moment. So in addition to having all of them either weakly bearish or in the case of Dow Jones Industrial Average being strongly bearish, because notice its green line has now dropped below the 50th percentile on the market forecast technical indicator, notice that all of them have slightly different looks when it comes to where is their current candle in relationship to where the 30-day moving average is for each of them. So let's talk about the good first. Down below here in the lower left, the NASDAQ, as you can see, has a green 30-day moving average. And what that means is price is currently above a rising moving average. Notice with these other 3 charts, that is not the case. The NASDAQ is the only one that has a green line there. We also know by reading the intermediate label within each of these 4 charts that the NASDAQ's reading is at 66 right now. Isn't that the sign of the devil or something like that? So maybe that's not a great sign there. Nonetheless, they are the leader of this group right now, because as you look at the Russell 2000, it is an intermediate reading of 61, which of course is less than 66, and the S&P 500 is at 54, again less than 66, and no surprise at all, the intermediate line for the Dow Jones is at 33. So again, another way to determine, not just by looking at the color of the background that the Dow is the laggard, but just from the absolute numbers in those labels, you can see that it is the one that is lagging the most. And from the opposite side of the perspective, the one that is leading the most is the NASDAQ composite. So there are two different things there. It's got its highest intermediate reading of these four, and it's the only one of the four that has a green moving average. So to me, it's pretty clear that at this exact moment, the NASDAQ is the leader and the Dow Jones is the laggard. The other two are a little bit tougher to figure out, but I'd probably say that in my eyes, the Russell 2000 is directly after the NASDAQ, because here you can see we're basically touching the underside of that rising 30-day moving average on the Russell 2000, whereas we've got a little bit more separation up there in the upper left with the S&P 500. Additionally, again, that intermediate reading on the Russell 2000 is 61, whereas it's only 54 on the S&P 500. So sometimes it's a little bit harder to determine with the naked eye who the leaders and the laggards are, but at this moment I don't really get that sense. And again, it doesn't mean that this is etched in stone and cannot change or anything like that. It just means that this is what we are dealing with at this exact moment in time, where the NASDAQ is the leader, the Russell 2000 is right behind it, the S&P 500 is doing its best to keep up, and the Dow Jones is clearly our laggard. In terms of putting a ribbon on it with the actual numbers from today's trading, the S&P 500 was up 0.53%, the Dow Jones was up 0.33%, the NASDAQ composite was up 0.72%, and the Russell 2000 was up 0.71%. So even on a one-day basis, you can see that this kind of shook out the way that our intermediate postures are shaking out. In other words, the NASDAQ was the best today, the Russell 2000 was second best today, the S&P 500 was third best today, and the Dow Jones was today's laggard. So I guess that is apropos, considering what we just got done talking about there a second ago with how to evaluate these companies on an intermediate basis. So things remain more bearish than perhaps we would prefer, but there is a little bit of hope there with the NASDAQ composite trying to stabilize right where you want it to, because you kind of want to see it use this rising 30-day moving average as a support level and a launch pad to bounce up and off of if you want to be bullish in these markets. So as things change and time goes along, of course, you'll hear from David and I fairly regularly in these videos, and of course, we'll point out what changes we're seeing as well. But that's what I'm seeing right now. Let's go ahead and take a look at our 3 green arrow status. Remember when I was with you on Tuesday, they were all 3 red arrows. Let's see if that has changed. It has, but not by much. The only change here at this point is that the NASDAQ composite is no longer in the 3 red arrows territory, because again, it closed above its moving average in that case. The other ones, as you can see, have that light pink background over today's candle, suggesting that we still have 3 red arrow signals on all 3 of those. And then if we were to look at our longer term chart, this is chart 4C here now. This is our 1040 crossover method chart. And remember that these charts are 3 years in length, and each one of the candles that you see are 1 week as an aggregation period. So a little bit different than those other charts we've looked at thus far. And in this case, you can see that it's a little bit of the opposite of what we see from an intermediate perspective. Remember, this is a longer term perspective now. And interestingly enough, the NASDAQ, which is the current intermediate leader, remains our longer term laggard, because it is the only one on this chart that currently has what's known as a death cross when you're looking at the 10-week moving average versus the 40-week moving average, with the 10-week being the orange line and the 40-week being the blue line. And so at this moment, they need a little bit more of a push from the bulls in order to get that more sensitive line up and over the less sensitive line. Remember, some of you might also use that technique of golden crosses and death crosses, but you might be using it on daily candles. And what you would be using is a 50-day moving average and a 200-day moving average. But the equivalent of that in weeks is a 10-week moving average and a 40-week moving average. So right now, the NASDAQ is the only one of these 3 that has not crossed back into bullish territory yet. Going back to what I had mentioned here just a moment ago, remember the Dow was last year's leader at the end of the year. So that's why you see this background color on the Dow being green for much longer than these other indices up there, because it was able to basically, offset that weakness last year much better than these other indices. Remember, the Dow at the end of the year was only down something like 8% or something. It was like high single digits, whereas the NASDAQ was down 33% last year. So that was, gut-wrenching for the NASDAQ. So you have to have a sharper rebound because it gave up a lot more of those gains during the year. Since the Dow Jones didn't really give up as many gains, they didn't need as sharp of a rebound, and therefore they were able to get a golden cross even before the start of this calendar year. Notice the Dow was the only one to do that. There's these little gray dotted lines on the chart that represent the yearly crossover point. And while the S&P 500 and the Russell 2000 now have that green background just like the Dow was, that just happened literally last week on the S&P 500 and just 4 weeks ago here on the Russell 2000, whereas the Dow has been in bullish crossover territory since the end of November of last year. But it is the one that is effectively just kind of going sideways here, not really giving you the impression that it wants to, add on to its gains. It kind of just front-loaded those gains late last year, and the others are playing a little bit of catch-up right now. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these Market Outlook presentations. And as I always say, as long as we're up and over 100 likes there on Twitter, I'm more than happy to do a full-length video for you, which includes the extra analysis of the 12 grids and the factor selectors and the trade application examples and all that kind of stuff. So if that's what you prefer, then you'll want to take the 5 seconds out of your day to click like. Remember, it's completely free to do that. If you, on the other hand, prefer the shorter ones, like I did this last Tuesday, where it's only 15 minutes in length without all those extra charts and analysis, then don't click like. So each day that I'm scheduled to do the video, which is typically Tuesdays and Thursdays, I will look at my like count, and if I'm below 100 likes, then I'll plan on just doing a 15-minute video for you guys. If I'm over 100 likes, then that gives me the impression that you guys are getting value out of these videos, and it's worth my extra effort and time to do the longer form version here. So it allows you guys to have a little bit more control over what it is that you would like to see out of us there as well. And also thank you, Adrian, for your sympathies there with my mom was having some health concerns here over the weekend, and it always impresses me to know how considerate the Market Scholars community is, and the love that you share with us as well. It is very much appreciated. And I've got good news on that as well. My mom actually came home from the hospital here today after having a heck of a go of things there last week. So thank you to you and all the other Market Scholars that have sent their words of encouragement to me. It means a lot. Let's go ahead and do some shout outs there to the 114 people that were willing to click like. How about we get, hang on just a second, there we go. How about we say thank you to Jonette, and thank you to Jimmy, thank you to John, and to William and Michelle, and Doug, and Austin, and Robert, and Terry, and Nietzsche, and Sheila, and Maria, and Tyler, and Bill, and Zika, and John, and Prickly Trader, and Renee, and Robert, and Ron, and Doug, and Fathy, and Nikolai, and Ash, and Jim, and Jayesh, Linda, and George, and Paul, and Ali. Too many to go through, lots of you here, but always like to at least acknowledge you and let you know that it is appreciated. It may seem a little silly for you to take that 5 seconds to click like, but it does mean a lot for David and I. So thank you to those of you that are committed to do that on a regular basis. It really helps us out quite a bit. As I mentioned before, we had a heck of a day at Market Scholars, where I put in a 4-hour and 40-minute class. So if you're interested in checking that out, feel free to do so. David's schedule is a little bit more rearranged today, but he's had some great content that he's posted to our class calendar here lately as well. And then as far as I know, he should be back in action with his technical analysis class tomorrow, which is always a fun time for our students. Let's talk about our factor selector now. A reminder that this gets posted on Wednesday morning, but it is using Tuesday night's closing information. And so it's a couple of days stale here. Remember, those of you that are premium members can always access it as fresh as possible on our website if you prefer. But it's kind of an interesting pattern here because we basically just eliminated last week's movements. As you can see, low size is back to number 1 where it was 3 weeks ago after having last week at the number 2 position. And then the exact opposite from a mirror image kind of perspective happened at the bottom, where momentum is back on the bottom rung. And it was there just a few weeks ago, but had a little bit of a get up and go just last week. So we just basically that happened week over week is we just reversed last week's movements. And sometimes that happens, right? There's certain things that happen in the market where the two different factors are neck and neck, and just by the slimmest of margins, one might beat the other one out one week, but it could be the exact opposite the next week. So one thing that I think was worth mentioning in these movements is that quality these days, from a factor perspective, is very much one of those factors that is affected by technology stocks. So remember that Microsoft and Apple are 2 out of the 3 companies in the United States that have a AAA balance sheet. And so that is oftentimes what that quality factor is trying to drive towards. And last week was a tougher week for the stock market. And oftentimes when the stock market is selling off a bit more heavily, technology from a sector perspective is out of favor. So from my perspective, that seems to be what's taking place there, but I would venture to guess it's pretty close. And if this market can rally again moving forward, then I would assume that technology could lead the way, like we saw with Nvidia today as just an example. And therefore, I wouldn't necessarily count quality out of the race yet. It's just that they had a poor week last week. So other than that, we didn't really see much in the way of change. You can see that number 3 and number 4 stayed exactly the same last week, with value and then dividend yield immediately after that. All right, let's go ahead and now pop back on over here to the platform, and let's do some 12 grid analysis. And so let me pop on over here to chart 5A. This is our asset class 12 grid. And a reminder that the background colors of these 12 grids that we use here in the Market Outlook video will be either pink or green. And if they're green, that means that there's currently a bullish intermediate posture using the market forecast technical indicator. And if they're pink, it means we currently have a bearish intermediate posture using that market forecast technical indicator. So at this moment, we have just 3 green charts on the board, and 2 of them I'm not necessarily excited about. And those are the 2 in the lower corners, as we've talked about endlessly for the last year. Most of you that have been tuning in beyond just this one video will know that I pretty much always start this conversation on these 12 grids with the lower 2 corners there, because that really is what kind of dictates what's happening within the stock market in this current era. In other words, when we have rising interest rates like we see down here in the lower right, it typically leads to falling stock prices for obvious reasons. Now today you will notice that the 10-year Treasury yield actually slipped, and it was a pretty big sell-off there, right? That candle that we're looking at there that I'm circling is a pretty large one. Let me right-click, maximize this so you guys can see this a little bit better. That's a pretty aggressive candle there. It's not nearly as big as like this one over here or this one over here, but it was a reasonable, pushback here today. For instance, yesterday was just a little bit of a sell-off, but not much to make out of. Today's was a little bit more aggressive there. So it does kind of make you wonder, after this huge move from basically bottoming here on February 2nd and going straight up, did we go up a little bit too far too fast, right? I think that would be a legitimate debate there. And maybe we just need to give back part of that move here in the short term, but it doesn't necessarily have to change the trajectory or the trend, right? And right now we can see the path of least resistance is now to the upside for interest rates. We have a rising 30-day moving average and prices above it. That's why it's colored green down below there as well. The other thing I would point out is that in this case, we have what's known as a bullish intermediate confirmation signal on TNX. The problem is it's hard to trade TNX because it's more of an index that you kind of glean insight from, not necessarily that you are trading. But remember, there are ETFs out there that can kind of emulate that experience. So for instance, one that would come to mind is TBT. This is basically like an inverse bond fund. So remember that when interest rates go up, bond prices go down. So if you're trading an inverse bond fund, then in this way, it's kind of like saying this is a fund that is designed to go up if interest rates go up in kind of an indirect way. And so you can see here when I pull up TBT, it also has that same impression down below, what we would refer to as a bullish intermediate confirmation signal, where the green line is considered bullish at this moment, at the same time that we have the red line in the lower reversal zone. And adding to the appeal of this setup right here is that our two follow-up kind of confirmation, or that's probably not the proper way to think about that. It's more of a way to determine whether the signal is more ideal or less ideal. And those two additions to the way that we think about that are, first of all, the blue line. We like to see that blue line somewhere between 50 and 20 on the bullish intermediate confirmation signals. And so you can see that is the case right here. The blue line is at 30 right now, clearly between 50 and 20. It tells us that there's been a healthy enough of a pullback. And to back it up a second, for those of you that aren't aware of that signal of a bullish intermediate confirmation signal, think of it as effectively a buy the dip signal. It's a way to recognize that the trend is reasonable from an intermediate perspective, so that green line is still bullish from an intermediate perspective, but at the same time, during that intermediate bullish move, there's a quick move lower in the more sensitive momentum line, which is basically saying we had a pullback in price, but we're still in the midst of a bullish intermediate move itself. And the blue line, as long as it's between 50 and 20, it tells us it's a little bit more of a healthy move, because every so often we'll get this signal, but the blue line is still like way up here at 80. And it basically means that there's been hardly any pullback at all. This has been a little bit of a healthier pullback that we've seen here on TBT. Now, in addition to that, we also look at where is the red line. Remember, for the signal, the red line has to be in the lower reversal zone, in other words, below 20. But if it ever gets down below 5, so in other words, between 0 and 5, sometimes that can be a precursor of worse things to come. In other words, it might not just be a buy the dips, it might actually be a dip that it should not be bought, because it could very well end up pulling the intermediate line lower. So in this case, the red line is where we want it as well. It's below 20, but not dramatically so. It's at 13 right now. So this is actually a pretty good example of that concept of a bullish intermediate confirmation signal, whether you're using the tradable TBT as an ETF or whether you're just simply looking at TNX to get a sense of where Treasury yields are right now. And we did end the day at 3.87% on the U.S. 10-year Treasury. Back over here to our 12 grid view now, and in the other corner we do see UUP, and remember, typically it's a little bit easier for the stock market to do well if the US dollar is weak. That may seem strange to those of us in the United States. It's just simply how things tend to work for a variety of reasons that I've mentioned in these videos in the past. But keep in mind that we have a lot of multinationals here for just one example of that, and just looking at comparisons of earnings when you're translating, you know, your earnings and sales and cash flows from euros back into dollars, it looks better for a company when the US dollar is weak and you're earning that extra money outside and then kind of onshoring it here in the US. So it's a little peculiar for those of you that are newer, but just at a high level, be aware that typically it's a little bit easier for the US stock market to advance if the US dollar is weak. But in this case, you can see the US dollar has strengthened here recently, and that's not necessarily doing the market any favors. As you can see, the stock market itself topped out up here with the SPY on Groundhog's Day on February 2nd, when it gave us that overbought cluster signal, and has basically gone straight down since then. down below, look at where the US dollar was. And on February 2nd, it was right here. In other words, the day before was the only other time on this chart that was lower for the US dollar. And you can see the US dollar has gone straight up since that time. At the exact same time, the US stock market has gone straight down. So, there is a strong inverse correlation with those asset classes there. So that goes back to what I mentioned a moment ago, where when we see the bottom two corners in the green like we do right now, that usually is not a good thing for those of us that like to participate in the stock market, at least on the bullish side of the equation. For those of you that have a lot of bearish trades, that's probably a good thing. But in general, you don't necessarily like to see that, right? On the flip side, notice that our third chart in the green here is the one off to the right in the middle rung, and this is Bitcoin. And Bitcoin is generally viewed as a risk-on asset class. Generally speaking, you don't see Bitcoin be strong at the same time that you have rising interest rates and a increasing US dollar. But this is one of those rare moments where that is the case. And we have recognized that Bitcoin has been strong all calendar year. Last year was exactly the opposite, right? Over and over and over again. We did see Bitcoin sell off last year alongside those tech stocks. Well, go back to what I had mentioned here earlier in the presentation. Right now, it's the tech stocks that are leading, right? The NASDAQ is the #1 index out of the four. Where do we find the most tech stocks? It's in the NASDAQ. So in a strange way, because technology is holding up a little bit better than other sectors, Bitcoin is able to also kind of retain what strength it had earlier in the year and actually start building on that a little bit. So we stand right now at around 24,000 on Bitcoin, and that is has been a nice rise on a percentage basis so far on a year-to-date level. So all in all, that you can put in the camp of the bulls. But the problem is there's probably a lot more bearishness out there that offsets the bullishness that we see out of Bitcoin. You can see down below here when it comes to our commodities that gold remains just kind of, icky, right? For lack of a better term. It's just not doing anything. It feels sick. It needs to get healthy again. And right now, it's just not showing any signs of that. We had a really amazing rally out of gold here for several months, and it topped out right here with this final overbought cluster signal, and it just has not wanted to get back on track. I was a little bit more optimistic right here when it was trying to hug that 30-day moving average. My hope was that it could get back up above it. It just wasn't in the cards. That thing drifted lower, and now all bets are off. Now keep in mind, we no longer have any gold trades in my market outlook presentation. We did last month on Newmont Mining, and that one was successfully closed down at max gain upon the February options expiration. So we played that one as successfully as we could have, and I'm waiting in the wings, and if gold can ever turn around once again, I'll be happy to look at those types of setups once again. But right now, you're just guessing, right? Because right now it appears that gold has more sellers, willing sellers, than willing buyers. And so you've got to be a little bit more cautious in an environment like that. Gold was down just barely today, 0.05%. But as you can see, clearly trading below its falling moving average and clearly still has a strongly bearish posture. Oil was a little bit of a different story today. It was up 2.25%, but as you can see from the background color, it remains strongly bearish just like gold does. It's just that its chart looks a little bit healthier because it's been chopping sideways for 3 months. Whereas right now we are in more selling pressure consistently with gold with very little buying pressure to offset it. With oil, it's a little different because, yes, we have selling pressure, but then it gets offset by buying pressure, and then we have selling pressure, and today we saw a little bit of buying. So, it's a little bit more debatable as to what's going on with oil right now, but at least it's holding hope that you do have some pretty firm support levels here, right? If you draw kind of like a horizontal line across where we bottomed yesterday, you'll see that there's a touch point not only yesterday, but of course right there, right there, right there, and then right back there as well. So maybe some interested buyers at those levels, but on the flip side of that conversation, you also have interested sellers up at these levels up here. So you're just kind of stuck going sideways on oil right now. And it just seems like it doesn't really know where it wants to go, whereas gold seems like it's got a little bit more of a mindset directionally to head bearishly at the moment. Because we did see a fallback in yields today, no surprise that our bond markets all closed in the green today. We saw the 10, or I'm sorry, not the 10-year, but the long-term U.S. Treasuries up basically a percentage point today, which remember is a big move for bonds, typically speaking. Foreign bonds were up 0.33%, and then high yield bonds also were basically up 1% today. So some decent moves there. If you look at that candle on high yield bonds and then also look at that candle on the long-term U.S. Treasuries, those are some pretty decent rebounds right there. Unfortunately, it wasn't big enough to offset what had already been a bearish intermediate posture. But if we get a couple more of those days, I do think that there's a chance that these background colors can start switching back to green. So we shall see. The problem is, my fear whenever we have a chart set up like this, nothing against these bond charts specifically, but just in general, when I see this setup, my assumption is, hey, we probably got a little bit oversold here. Now we're kind of reverting to the mean, and now I want to keep my eyes on how does it handle things once it gets to that falling 30-day moving average. Here's junk bonds, and over here is U.S. government bonds. And, you know, more times than not, you tend to find that there is some selling pressure there. So, in other words, no surprise that we're getting a bounce. Every chart gets a bounce here and there. The real question is, do we have enough oomph in the midst of that bounce to basically change the trajectory of the chart? I'm not going to rule it out in these cases, because what you will find with this pattern over the last 3 months is you will see that we protected that prior low. So notice, like on junk bonds, the low here recently was on the 21st of February, and that did not breach the lows of late last year. Similar thing over here on U.S. government bonds, where our low was on the 21st a couple of days ago, and they did not breach those lows there. So from kind of a wider angle, you can kind of see that at least on junk bonds, you still have this pattern of higher highs and higher lows, but it is really choppy, and you know they're wide swaths. Normally when you're in good trend trades, they don't have these big of movements up and down. They're usually doing their trending in smaller movements above a moving average. These charts are a little different because it's not afraid to cut straight through the moving averages. So, you know, it's kind of debatable where we're going to shake out on that. But at least there's a little window of optimism from that perspective that maybe, just maybe, it could get up and through that falling moving average, because it did so last time around. Why couldn't it do it again, right? So maybe, just maybe, you can see that play out that way. On the top rung here, you can see that the foreign markets were basically in line with the U.S. markets today. All of these 3 different charts up at the top were basically up 0.5% here today. So not a whole lot to share with you there, but be aware that the EEM, which tracks the foreign emerging markets, does have a strongly bearish posture as opposed to the weekly bearish postures over here, and it's the only one that has a red moving average with price below a falling moving average at this point. These other 2 moving averages are still rising at the moment. All right, let's go ahead and now pop on over here, take a look at our sectors today and see what sort of insights we can glean. And as you can see, we've got mostly pink charts on the board. In fact, the only one that you can probably even barely make out because it's the lighter shading of the green, but technically down below here, the staples do have a light green background color, telling us that we do have a weekly bullish posture. And remember, that's not a good thing. You do not want the staples to be leading the market, because it basically means the market is concerned. The staples are where people go when they're scared about the cyclical and growth areas of the market. So in general, while it is beneficial to me personally, because the staples are my largest sector allocation as a dividend investor, but that is always the case. It's not like I selected that for this moment in time or anything. It's just that's the way it always is. And so when staples are good, you know, that's the way it is. And when staples are bad, I got to put up with that as well. But in general, high level speaking, you should probably not want the staples to be in the leadership role, because they do have those defensive characteristics, which effectively tells you that the market is a little bit more concerned at this moment in time. All the other charts are either light pink or dark pink. In terms of, you know, where did we see any strength versus weakness today? Technology no surprise, was our leader today. It was up 1.66%. And remember what I showed you there on the heat map where NVIDIA was up 14%. And NVIDIA is the type of company that can move an entire sector. Now, to be fair, NVIDIA is playing in a very big ocean with both Apple and Microsoft in there. So even its $500 billion status is looked at as somewhat small compared to those big whales out there. Whereas a $500 million market cap in nearly any other sector would make it the biggest company in those other sectors. But nonetheless, today was a good day for technology, largely because of NVIDIA, and it did lead all markets, or all sectors, I should say, with an advance of 1.66%. Just behind it, by the way, was energy. Not too far behind it at an advance of 1.51% there. In terms of where our losers were here today, it looks like it would have been utilities down 0.52%. And again, that should not come as a surprise based upon what we learned when we evaluated the heat map at the beginning of the presentation either, because remember, that was the sector I specifically pointed out that to my eye looked like it had most of its components in the red today. So it wasn't necessarily because of one single stock like NVIDIA was for technology. There it was just consistent selling across the board. And remember, for utilities, that is fairly typical. There are some sectors that are very wide-ranging. I would call technology one of those types of sectors. I would also call discretionary. I would also call healthcare those types of sectors, where you have industries within the sectors that can sometimes deviate from one another widely. But typically what you find out of utilities and also REITs is they generally all go up together and generally all go down together as well. So you kind of have to put up with that aspect of things there. On the flip side of the conversation, notice that for the second time in a couple of weeks, we have another oversold cluster signal on utilities. And remember, I happened to be with you, not David, the day that we got the last one, right here on February 9th. And I said, be on the lookout for a possible rebound out of utilities. Not that it would be trend changing, just simply we got oversold and we needed to correct that. Well, look at what happened. Utilities were probably one of the leading sectors in that next 6-day window where you had 3 awfully big candles to the upside before spilling over once again. So could we be setting up for a little bit of a bounce here in the utilities once again in the short term? I think it's possible, but obviously I don't have a crystal ball either, so we shall see. But at least I wanted to point that out to you in case some of you have a very specific philosophy or approach with clusters. Today we do have utilities as the only oversold cluster on the board from a sector perspective. Yesterday we did have an oversold cluster from healthcare, and today healthcare bounced a little bit. So maybe tomorrow we get a little bit of a bounce out of the utilities. We shall see. I should also point out that I kind of like the way that technology's chart looks. When I maximize this, you'll see that we have this nice formation here where we had this give back after a really big breakout during this period. We had this kind of 4-day give back right here, but notice where it ended. Right on the upward trending 30-day moving average. And then today you had that really nice bounce up and off of it. And that's kind of what you want to see. Some of you that have been with us for a number of years, even stretching back to the time when David and I were at TD Ameritrade, you'll know the acronym CAHOLD, or a close above the high of the low day. And that is what we received on the entire technology sector today. So that bodes pretty well for our trade application example. So let's segue into that now. And I will bring up chart 4A. Actually, I'm going to do, take that back. I'm going to do chart 3A. That's our swing trading chart that I use. And the stock that I want to bring up is SWKS. And for those of you that are familiar with that ticker symbol, it's Skyworks Solutions, and it is a company that is in the guts of an iPhone. So while most of you might not recognize it from its brand name, most of you use it perhaps unknowingly if you are an iPhone user or an iPad user or what have you. So it makes up a lot of the electronic components within iPhones as an example. So if the iPhone is selling like hotcakes, then this company, generally speaking, can do pretty well as well. It has certainly rode the iPhone phenomenon over the years. If we were to go back on a 20-year chart, Remember that the iPhone was released back in 2007. I was actually one of those guys that bought the very first iPhone. So normally I'm not like I'm not one of those early adopters, as they call them. But for that one, I knew it was a game changer as soon as I saw the iPhone. I'm like, are you kidding me? It's that slick to get onto the internet. No more buttons, a full screen. Like I was already in love at first sight with the iPhone, and I've had an iPhone every single year since then. I've never gone to any other device, and I think many of you are probably the same way. It's pretty rare for somebody to be like an iPhone user and then switch to Android the next year and then switch back. Usually once you're on a certain mobile platform, you stick with them. And as you can see with Skyworks Solutions, back here in 2007, this stock was really kind of just treading sideways, right? It was basically going sideways. And this is a stock that was basically a $6 stock there. It might be split adjusted, but nonetheless, you can see that for years it was going nowhere. It was just going sideways and probably frustrating a whole lot of investors. Well, once the iPhone was launched, you can see the entire trajectory of this company change as well, even though this is not Apple that we're looking at. This is just a company that's riding the coattails of Apple, as this $6 stock became what today is a $113 stock. So massive, massive amounts of rewards for shareholders over the years. We were actually talking about Skyworks Solutions a little bit earlier in my class today, because we were talking about how we were looking at it in my dividend classes last fall, as it had a rare 3% dividend yield. Right here, it fell down here to around $80 or thereabouts, and at that time it had a 3% dividend yield. Now obviously it's rebounded from there, so its yield has come down to 2.19%, but it is still considered somewhat attractive from a longer term perspective, where it is with its yield territory right now. That was not the primary driver of why I did the trade that I ultimately did, but I think it's at least supporting evidence of the journey that Skyworks Solutions has been on over the years. The real reason I was interested in Skyworks Solutions today, because it had the same type of bounce pattern that I showed you there a moment ago with the technology sector itself. The other thing I should mention is that I got this trade done awfully late today, so I apologize to those of you who are premium members. Normally I want to get my trade done about 15 minutes before the market closed, but today's was there right at around like 5 minutes before the close. So normally I want to get the trade done earlier, but my problem today, as does come up occasionally, is the trades that I want to do start moving against me, and as I start trying to chase them by replacing my orders and trying to bend towards the market's will, it keeps on moving away from me, and I just feel like I'm chasing this price around. And so the trade that I was actually planning on doing today, as kind of an alternative trade idea for those of you watching tonight, was I actually wanted to do a bearish trade on Schwab here. And so that one just didn't pan out, so I ended up having to go back on over to the trade that ultimately got filled there for me, which was Skyworks Solutions. So anyway, if you're looking for a bearish trade setup here tonight, maybe Schwab is one that can get you done. But I just was simply not able to get my bear call spread done at the price that I wanted. When I first saw it, it was trading for, I think, 58 cents, and it was a $2.50 wide call spread. And as soon as I put it in at 58 cents, it immediately went to 57 cents. And I'm like, all right, I'll change it to 57. And of course, as soon as I change it to 57, it moves to 56. And I even changed it one last time to 56, and it would not fill me there. So I was running out of time, and I had stumbled across the Skyworks solution chart as it was on my mind from earlier today in our question and answer session. And I figured, you know what, I could probably use a little bit more bullishness in the account anyway, because most of my trades are either bearish or neutral right now. So what the heck, let's do a rare bullish trade here. We've got the evidence to help support that, because as you can see, we do have a bounce up and off of the moving average. And you have kind of that Cahold type of a feel there as well. It might not be perfectly a Cahold the way that XLK was, but it gives you that same impression there that after a 4, or in this case 5-day pullback, it's kind of, oversold in the short term, and we could very well get a bounce up and off of that moving average from this point forward. You will notice that with this bounce today, the blue line got out of the lower reversal zone, thus painting the background of that color chart blue, letting us know that the posture is now bullish from a near-term perspective, even though the intermediate posture is still falling in this particular case. I would also point out that this line that you see here on the chart represents where my break even is, because what I opted to do for this particular trade was to sell the 105 100 bull put spread in the month of April. The Marches are too few a days now, where I just wasn't comfortable with the strike prices, trying to get the 30% return on risk. So I opted to go out an extra month to April. So the April's maybe feeling a little bit too long, but the Marches felt a little too short. So you just kind of have to deal with, whatever is available to you. But in this case, I opted to go with the Aprils, which is just under 60 days until expiration. I think it's like 56 or 57 days, something like that. And again, I sold the 105 put and I bought the 100 put, and I received a credit of $1.14 for doing that, which is exactly on a 30% return on risk. And that means that my break even on that trade, when I subtract $1.14 from my 105 obligation, then that means that my break even on this bull put spread is at 103.86. And so you can see that that does team up nicely from this prior resistance area back here on January 18th. And sometimes old resistance can become new support, but my real hope is that we're actually in the midst of starting an actual bounce right here. I don't want it to break down to those levels and even test it. My hope is that we're starting to kind of at least stabilize around this rising moving average. And for those of you that are newer to this trade idea of selling a bull put spread, remember, it's not a highly directional strategy. It's not like buying calls or even buying a call spread where we do one in the money, one out of the money. This one, as a sold put spread, is a lot more forgiving because it allows for the trade to go sideways and you still to make money on it, whereas other directional bullish trades need the stock to actually go up. This one does not. What I want out of this trade, ideally, is for the stock to go up, because the further away it goes from this blue line, the more comfortable I'm going to feel in the trade as the trade progresses. But if I'm wrong about this and this stock rolls over because the whole market rolls over or for whatever other reason, then I've got a little bit of leeway here between where it's trading right now at 113 and where my break even is down there about $10 lower than that. And so if it does kind of either go sideways or even goes lower but does not go lower by more than $10 per share between now and the middle of April, I can still make money on this trade. If it does go lower by more than $10 per share, then I'm going to end up taking a loss on it. So it's a little bit more flexible, a little bit more forgiving. It's not an aggressively bullish trade, but at least has some markings on the chart as to why, a bounce trader might be interested in the setup at these levels. Okay, so that's what I had for you here tonight. Again, I appreciate you checking it out. Remember, if you do like these longer form videos, that includes the extra analysis on the 12 grids and on the factor selector and also a trade application example, you'll want to go out there and take the 5 seconds out of your day to click like for me there on Twitter. Remember, the tweet in question will be pinned to the top of my timeline on Twitter. It will also be directly below the video for those of you who are watching it on our website at Market Scholars. For those of you that are watching this video directly on YouTube, you can find the tweet in question in the description area. And then last but not least, the fourth place to find it is in the email that all of you get that are on the distribution list. There'll be a little Twitter icon at the bottom that you can click on that'll take you there. So those 4 different ways, either way will kind of add you to the tally, so to speak. And as long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, it'll be another hour-long long form video. On the other hand, if you think these are getting a little bit long in the tooth and you'd prefer me to only stick to the basics and want me to do just a 15-minute video, then don't click like on Twitter. So I'll let you guys decide there in the end. Regardless of what you decide, thank you for checking out tonight's video. David should be back with you here either tomorrow or at some point over the weekend, and then I'll see most of you early next week. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.